In the realm of finances, vigilance is key, especially when tax season is nigh. Let's delve into some common IRS audit triggers. Firstly, failing to report all income. Remember, the IRS doesn't rely solely on your honesty. Companies that pay you also report to the IRS. So if you're a contractor, your income will be on a 1099 form. If you're self-employed, you may receive several of these. Each 1099 is sent to you and the IRS. If you neglect to report one, the IRS will eventually catch on. Secondly, overclaiming charitable donations. While the government appreciates generosity, excessive donations relative to your income could raise eyebrows. For instance, if you earn $45,000 annually but claim a $15,000 donation, expect queries. If you're exceptionally charitable, maintain solid records to back up your claims. Thirdly, running a cash-intensive business. Large cash transactions like deposits exceeding $10,000 may be reported to the IRS. Cash lacks the paper trail of credit cards, which the IRS prefers. Reporting low earnings while dealing with substantial cash could wave a red flag. Similarly, businesses spending large amounts of cash could pique the IRS's curiosity. Lastly, over-reporting losses. While all businesses have expenses, personal expenses masquerading as business ones won't fool the IRS. Attempting to reduce your tax bill by claiming excessive losses will likely draw their attention. A stitch in time saves 9, and that applies to your finances too. Stay vigilant, stay honest, and stay out of trouble.